Hello everyone. Have you ever checked a US employee paycheck and noticed another tax deduction called state withholding tax? Why does it differ from state to state? And why do some employees pay zero state tax while others pay much higher deductions? In today's video, we are going to understand state withholding tax in the simplest way possible. So if you are learning US payroll, accounting or taxation, this video is perfect for you. Let's begin. What is state withholding tax? State withholding tax is the amount deducted by an employer from employee wages for state income tax purposes. This tax is paid to the employee's state government. For example, if employee is working in CA state, California state, so the taxes will go to California state government. Unlike federal tax, state tax rules differ from state to state in the USA. For example, federal tax, there is some wage bracket method or percentage method, but that is applied on all 50 states of US. But state tax varies state to state. In some states the percentage is lower, in some states the percentage is higher. So why state collects income tax? State governments use tax money for road and transportation, public schools, police and fire departments, healthcare programs and government operations. Just like federal withholding, state withholding is deducted gradually from each paycheck. As I had mentioned in the last video, that federal withholding tax is deducted from the employee's paycheck, in the same way state withholding is deducted from the employee's paycheck. The only difference is federal withholding is submitted by the employer to the IRS, Internal Revenue Services, the federal department, but state withholding is deposited to the respective state's department. So we will discuss about the difference between federal and state withholding as well. So talking about the first point, in federal withholding, the federal withholding is paid to the federal government, state withholding is paid to the state government. Federal withholding rules apply across US, the same rule is applied on the all 50 states, but in state withholding rules differ by state to state. Federal withholding managed by IRS, and employers submit all the calculation and taxes to IRS, but in state withholding it is managed by the state tax agencies. For federal withholding, same federal tax system. For state withholding, different tax system. Federal taxes are managed by Internal Revenue Services, as I had discussed that before. State tax are managed by each individual state's tax department. States with no state income tax. There are few states where state income tax will not apply. So not every US state charges income tax. Below states currently have no state income tax on wages, and those states are Texas, Florida, Nevada, Tennessee and Washington. Employees working in these states may not see state withholding deduction in payroll. States with high income tax. So some of the states where the state income tax is higher, and some of those states are California, New York, Oregon, Hawaii. Employees in these states usually see larger state tax deductions. How state withholding is calculated? So calculation depends on state tax rates, employee wages, filing status, allowance or exemptions and payroll frequency. The tax rates depends on the state to state, and it changes on quarterly basis, or it can be changed on monthly basis as well. Some states use flat tax rate, others use progressive tax brackets. Local tax. State income tax, there some of the cities taxes have been applied in your paychecks as well. So we will discuss about that here, this local tax topic. Some cities or local government allow also charges payroll taxes. For example, New York City tax. If you are in New York, then you have to pay federal withholding tax, you have to pay social security, Medicare, FUTA, SUTA, and then you have to pay state withholding tax, plus you have to pay local taxes as well, the New York City tax. In the same way, Philadelphia local tax. So employees may see federal taxes, state taxes, local taxes in their paycheck, all separately. What is the employer's responsibilities related to these taxes? Employers must register with state tax agencies. If employer has to be registered with the state tax agency, and after that he can deduct the state withholding tax from the employee's paycheck. Calculate correct withholding amount, deposit taxes on the time to the state government, file state payroll reports as well, the quarterly returns, and provide employee tax forms. Incorrect withholding may result in penalties, interest, and state notices to the employers. Year-end forms. At the year-end, employees receive Form W2 as their income proof from the employer. This form includes federal wages, federal withholding, state withholding. Employee use this form while filing their tax return at the year end. So that was related to state withholding tax. So today we learned what state withholding tax is, why it exists, how it is calculated, and why tax deductions differ from one state to another. Understanding these payroll concepts is very important if you want to build a career in US payroll or accounting. If this video helped you, make sure to like this video, subscribe to CPK Books and Accounts channel, and turn on the notification bell for more easy to understand payroll content. Thank you for watching, and I'll see you in the next video.